Welcome everybody to the afternoon seminar here with SKAGEN Global. We're going to give you an update on the Q1 fund performance, positioning, and in particular we're going to have a focus today on the companies. We want to sort of get back to the core of the philosophy here and talk more about the companies that we have in the portfolio. But if we dive into the market here, and here you can see the gross performance both for SKAGEN Global and the index. And first observation is that it's been, of course, a strong start to the year for the market here. Basically a typical annual type return, 9-10% already in the first quarter, and also sort of a good start for the fund here, which is ahead of the index here on the various time periods, year to date, 3 and 5 years, lagging a little bit on the 10-year here, but we hope those figures will improve during the year. So that's been a good start for everybody invested in the fund. And it's also kind of worth pointing out that this performance for SKAGEN Global has been driven not so much by these magnificent 7 stocks that get a lot of attention in the media these days. As a reminder, we only own 2 of the 7 stocks, and currently only 1 of them on the top 10 list. So our performance has been driven largely by other holdings in the fund. And we can also note, as you see on this graph, which is from the Global Fund Manager Survey that Bank of America conducts on a monthly basis with hundreds of global investors to get a view of how market players are positioned, that the Magnificent Seven, they remain a very crowded trade. And as you know, SKAGEN's contrarian thinking is often to go against the flow, and if everybody sort of in quotes is invested in these stocks, we are unlikely to be fully invested in them. Another on that theme, sort of another interesting observation, we've seen sort of a spin-offs of these Magnificent Seven themes in other markets beginning to take place. People talk about the 7 samurai stocks in Japan, and even Pakistan has this sort of Magnificent 7 stocks named by one sourcer. So to us, this is sort of a sign that this area is getting probably a little bit too hot and overhyped at the moment. So let's instead then go back and look at what we have in the fund and what has been sort of the good performers for SKAGEN Global in the first quarter. We have Brown & Brown, ASML, and JP Morgan on the top list. And we also want to highlight things that have been performing a little bit worse to make it a balanced communication here. And then we have Nike, DSV, and Mainfreight being the bottom 3 performers. And we're going to spend some time now to talk a little bit more about each of these cases and describe the companies. So if we begin with Brown & Brown, this is an insurance brokerage firm, meaning that they don't really do any underwriting. They don't take on risk on their own books. Instead, as this picture illustrates here on the right, they are a middleman, meaning that they help connect buyers and sellers of insurance. And that's something that we like a lot from a business model perspective, because they are sort of clipping a coupon. They have a very capital efficient business model. And in particular, they don't have this big downside risk, sort of this black book. You don't know exactly what's on the underwriting record that you will have in more traditional insurance companies. Brown & Brown posted a very strong organic revenue growth during the first quarter. They came in at nearly 8%, which is above our long-term expectations for the company sort of top line. So that was well received by the market. And one factor kind of driving this is that you have seen an increase in insurance premiums basically across the board over the past couple of years. Those of you who looked at the US inflation data that came out yesterday may have noticed that car insurance in the US is up by 22% over the past 12 months. So of course, somebody like Brown & Brown, which again takes a commission, for them, higher premiums basically means higher income. Then it's also important to keep in mind that even if you sort of make a lot of money, even if you're profitable, you need to spend the money in a prudent way. And we picked up this quote sort of in yellow or orange here from the Brown & Brown CFO at the last Capital Markets Day last September. Brown & Brown is a family-owned company, and like you says in here, that they spend the money as if it is their own money, because it is their own money, given that the Brown family controls a bit more than 20% of the company. And they are now on the third generation of the Brown family running Brown & Brown. So we believe that we are in a good sort of place here with being very well aligned with the family. So that's one that we like and continue to like. A second one in a very different area is ASML. ASML is the Dutch company producing state-of-the-art machinery or equipment for producing semiconductor chips. So kind of looking at the picture, this is sort of one of the big machines that cost several $100 million to produce, and where ASML essentially have the monopoly on this in the world. No one else is anywhere close to producing these type of machines. ASML in Q1, they delivered record bookings, about 9 billion euros. Obviously, demand in the world for this type of top chips is very, very strong. It can also have been boosted by the fact that there are some restrictions, export restrictions coming on what can be sold to China in this area, and maybe the Chinese put in some extra orders before the window closes, so something to keep in mind. We're going to go down to Holland in November when ASML will host its next Capital Markets Day, and we look forward to communicating our conclusions from that trip later on in the year. Also, a very strong balance sheet with net cash for ASML, which is good to see, of course. Then the third one that was on the top list here for Q1 is JP Morgan. And as a reminder, JP Morgan is the only bank that's owned in SKAGEN Global. I think everyone listening knows about JP Morgan, so it doesn't really need to be explained in any detail, but we like the way the bank is being managed. We think that they adhere to the principles that are key in the financial services industry, recruiting top talent, maintaining a strong balance sheet, and having a kind of a solid leadership, which Jamie Dimon, who has been in charge of JP Morgan for well over a decade, I think actually even closer to 17 years, he has been navigating the world in a very successful way. As you may recall, there was a lot of turmoil in the regional bank sector last spring actually, with Silicon Valley Bank going bankrupt, First Republic Bank essentially also being sold at a very, very attractive price, that is low price or attractive price for the buyer, which happened to be JP Morgan. They have a strong balance sheet, JP Morgan that is, so they could use it to take advantage of the assets of the banks that are running into trouble, which First Republic Bank obviously did last spring. Those of you who want to read more about JP Morgan and CEO Jamie Dimon's observations, he just released a few days ago the shareholder letter. It is maybe a little bit long to be called a letter. It's about 60 pages, but contains a lot of good material. So reading we can recommend for sure. Then if we move on and look at the bottom three performers for the fund in the Q1, we had Nike being the worst performer. Nike, again, doesn't really require much any description what it is about, what the company is about. But they have faced some headwinds for a while. For example, during the pandemic, they had excessive inventory. China, which has been a growth engine for Nike in the past few years, has not really come back strongly after the pandemic. We've also seen that Nike's strategic initiative, where they were going to sell more direct to consumer, for example, through digital channels, hasn't really played out as successfully as the company probably had hoped. So we are seeing Nike products coming back and being sold through other distribution channels, for example, the big US department stores. So of course, I mean, this means that there are some question marks sort of in this case, obviously also reflected in the weaker stock price. But nevertheless, also important to keep in mind that the brand remains incredibly strong. If you look at Interbrand's ranking, the best global brand survey or 2023, Nike comes in here right after Coca-Cola on place number 9 in the list here. So it has been many cases in the past when Nike has had some operational challenges, but the brand strength has eventually played out and helped the company to get back. And we think this time is likely to be similar. Then we have two more sort of on this bottom 3 list, DSV and Mainfreight, and they are both sort of in a similar category. DSV is the Danish logistics firm. They are, to be exact, the freight forwarder, which means a little bit similar to Brown & Brown, that they are a middleman. They connect the shippers and the receivers of goods. They don't own any really of the assets. In other words, they don't own any airplanes. They don't own any ships. They usually don't own these trucks that you will see on the roads a lot in Scandinavia, but also in other parts of Europe. So that means, again, that they have a very capital efficient model. But like any freight company, there is, of course, a cyclical element to the story. And as everyone knows, the global economy is somewhat sluggish currently. So this is probably a part of the portfolio that will see stronger performance when the global economy picks up a little bit. And that makes sense, I mean, for us. I mean, we talk about that we're going to have a fund that has a sort of all-weather profile. So there will be some parts that will be a little bit weaker depending on the economy, and other parts that will be stronger when the economy turns. We also note that there was recently a shift in the CEO position at DSV. Jens Lund is the name of the new CEO. So he's a new CEO, but he's certainly not new to DSV. He joined DSV back in, I think, around 2002 as a CFO. And then he was CFO for nearly 20 years before he became COO. And then now he has become CEO. So he knows the company very well, and we believe that he's going to continue to drive the DSV success story going forward. And then to wrap up here, we can mention Mainfreight, which is a holding far away from the Nordics. This is our holding in New Zealand. They have about half of their business in Australia and New Zealand. The other half is spread out across Asia, Europe, and North America. And they also kind of work as a logistics firm. They have many similarities with DSV. And obviously, they also face similar market dynamics as DSV does. You can see on the right here some pictures from the intermodal terminal warehouse that they recently opened up in Sydney. And what it means is that if you look at kind of the corner here on the right, this is where all these big containers come in, containers that you will see on railway cars or the big freight ships kind of being stacked on top of each other, and then they're taken to the warehouse and obviously later on distributed on a more local basis. So main trade is about a 1% size in the fund. The company is led still by the founder, a very strong culture, and the stock has sort of been treading water for a while. So we think it's due for an upturn here, as again, probably when the economy gets a little bit better from where it is. Then if we look at the key changes, and this is a slide showing you what the key changes were in 2023, because we have not initiated any new positions. We also have not sold any positions in the fund during the first quarter of 2024. What we have done though is that we have done some reshuffling or some trimming and adding to the positions in the fund, and a couple of the key ones would be, for example, Microsoft, which has been one of the biggest positions in the fund for the past few years. We have now scaled down that position to make it more like an average size position in the fund. And we have done that not because we don't like the Microsoft story, but simply because we think that the valuation has become a little bit more demanding than it used to be, given the strong performance by the stock. So it makes sense for us as value investors to reflect that, to reflect a little bit less upside by taking down the position size. Conversely, we have taken up, so increased the size of positions where we see more upside. TMX is one of them. As you may recall, TMX is the exchange operator in Canada. So they run the Toronto Stock Exchange. They also operate the Montreal Derivatives Exchange. And that's a stock that has been performing well so far since we got into it last year. And we continue to see a pretty large upside in that name. Also Visa, MasterCard, Abbott Laboratories are examples of other stocks where we have been adding some to the position size. So that takes us to how the fund is currently positioned. And just to reiterate, you've seen this one before, that we are an active manager. We're certainly not hugging the benchmark. SKAGEN Global looks very different from the index. And you can see we don't have any exposure currently in energy, materials, utilities, or real estate. We have an underweight in technology. We have, according to the classification by MSCI, a big overweight in financials. And if anybody wonders, how would that sector overweight impact performance if, say, interest rates begin to go down from the currently higher levels? Well, the answer is that most of this exposure, essentially all of this that we highlight here, are stocks that are, in our view, not that much connected to the interest rate level, because we see these stocks as kind of hybrid financial companies, meaning that they are partly financials, they're partly technology companies, maybe partly services. So companies like Brown & Brown, TMX, Moody's, Visa, MasterCard, they have very, very different underlying drivers, and certainly not that closely connected to a bank. And like we said, the only bank we have is JP Morgan, which is sort of this part on the left here, about 4.5% of the fund. So then also we want to again highlight the importance of thinking about downside in the fund. I mean, it's always more fun to talk about upside in a stock in the fund, but for us it's also important to protect the capital and be prepared in case something unexpectedly bad would happen, for example, in the world economy or in the world of politics, geopolitics, and so forth. So we continue to favor companies that have strong business models, strong competitive advantages, and especially strong balance sheets. We also think about the political climate. As you may recall, we haven't had anything in Russia for many years. We haven't had anything in Turkey since 2016. And we continue to be what we think prudent about where we kind of put the capital to use. SKAGEN Global has an unconstrained mandate, so we don't have to be in any geography if the risk reward looks unappealing. With that said, even of course a challenging region could have attractive sort of individual stocks in them. But again, for us, we take a sort of a measured approach in this regard. And sort of as a last point here in terms of risk management, another part of that thinking is the importance of being aligned with management. Again, there's no guarantee that even if management has a lot of stocks or equity ownership, like these examples show from the portfolio, that they will always act in the minority shareholders' best interest. But we think that it is certainly a contributor in a positive way to us. And just like the investors in SKAGEN Global want to see SKAGEN Global portfolio managers being invested in the fund, just like we are. Of course, we want to see our company management being personally invested in their company's fortune as well. Then looking at the top 10 list for the fund, we talked about the balance sheets here, kind of to, again, I want to bring that up to kind of show you how we compared to the index. We are as strong, if not stronger, on most of these metrics for the top 10 or for the whole fund. And you can note also that, like in the top 10 in the fund, the largest position has a little bit higher net debt EBITDA. And that is because Canadian Pacific, as you may recall from our previous updates, that it acquired Kansas City Southern and took on some debt for that acquisition. But the company is now rapidly paying down that debt. So we expect them to go below 3 times pretty soon, most likely even by the end of this year. And then when they're kind of down to about 2.5 times, then they can really kick off the buyback programs, which can be a nice kicker to the earnings profile. But overall, kind of looking at the upside, we're sort of at roughly 40% upside for the fund, and this is the upside based on our price targets, our assessments of the valuations of the stocks, where they should be in the next 2.5 years. Maybe a couple of months more, but roughly that time period. So a little bit more than 2.5 years out. And if you kind of roll back the clock to January 1st, given the increase in the stock market so far, you would have been at something like a 50% at that time. So the fund's run rate of return can of course never be guaranteed, but we think that the portfolio looks attractively valued, and if these price targets turn out to be a reflection of how reality plays out, then the fund can continue sort of along the track that it's had over the past few years, which to us looks like a pretty attractive investment proposition. And the ones who will drive that return will be, among others, these names. So here is sort of the team roster. Of course, it's not the whole portfolio, but it's many of our names, a good mix of from sectors, different sizes, different geographies of the companies. And on this, also wanted to point out Dollar General, which was one that had a challenging 2023. As you may recall from our updates last year, we did take advantage of that setback for the company, and we added some to the position. And the stock was down sort of in the just above $100, sort of at the low point last year. But it has recovered nicely. It is now up above $150. So it's been a pretty steep recovery. You may recall that they brought in an ex-CEO to take over the position and sort of steady the ship. And this CEO, Todd Vasos, he has introduced sort of a back to basics strategy that to us looks very sensible. It is still, of course, too early to draw any firm conclusions how it's playing out. But if it continues to show good results, we expect the stock price to go up meaningfully from the current level. So that is a positive one. So to summarize, we see a good outlook for the fund. We don't know exactly what's going to happen with the world economy, if interest rates are going to go up and down, what's going to happen with inflation. We don't have to make those macro predictions because we think we have a portfolio that is well prepared for a number of different scenarios in the world. So with that, I will turn it back to our host, Ole Christian.
Thank you very much indeed, Knut. That's really interesting. Now, I'd just like to have you answer one question, and that's about the ever-recurring theme of AI, artificial intelligence. There are quite a few similarities with the dot-com bubble at the beginning of the century, what is playing out right now. And in theory, many of the AI companies will fold eventually, and some will be left as winners. What is your take on the AI mania that we are currently experiencing?
Yeah, no, I mean, that's the question that we've been getting a lot here over the past few months here. So we have talked about that, and we have some material to share on this as well. I mean, when we talk about and think about the AI hype or the AI theme, which is obviously going to be important, but you make a great kind of point there about the difficulty of picking out the winner, given that many contenders in that field will perish. And we kind of take the approach of the gold rush, sort of looking more at the selling the picks and shovels on it. As you recall, we talked previously about ASML being a company that is producing these state-of-the-art chips, data chips, or the machine for making the chips. So whoever is going to win the AI race, they will need to get a machine from ASML. So we don't have to, again, try to sort out who's going to win the AI, because they will use this equipment regardless of who it is. As long as ASML, of course, provides the best machine or the best equipment for this. And that's not the only. I mean, there are, of course, also other similar ways to play this on the same theme. We are looking at a couple of names that could enter the portfolio if and when the valuation and fundamentals and everything else sort of looks right. But we also wanted to highlight that it's not only ASML in the portfolio that is sort of a way to benefit from the AI theme. I mean, in fact, most companies, will to some extent benefit if AI continues to develop. But to point out a few in the fund that maybe have a little bit more exposure in ways, one would be Relics, which is a company that is not often talked about, pretty seldom that it's in the media. It has a few different divisions, but one of the divisions is about the legal industry, to which it provides databases, electronic tools to help legal professionals, lawyers, for example, prepare for court cases. Now, with the kind of latest platform here that they offer, they can help to really produce pretty effective legal advice or arguments for these law firms, and there's a lot of money in these law firms. So if Relics can provide them a useful tool, a good product, certainly Relics can benefit from this development, and continue to grow this product suite, which we think remains underappreciated by the market over the longer term. Another example is Intuitive Surgical. They make this Da Vinci robot that you may have seen many good videos on YouTube about it. It is sort of has become the standard care for prostate cancer treatment, but also sort of for other forms of cancer. And here, if you kind of think about the possibilities, collecting data from surgeries, running it over big data sets to improve the care, to improve how you apply it, then can expand, of course, to other forms as well. We think that what the AI development can do in healthcare, and especially in this company, we're kind of only scratching the surface. Maybe also worth mentioning here that this is a small position in the fund because we think that valuation is relatively stretched currently, even though the long-term story continues to look compelling. And then maybe the final comment on this question, just about Google or Alphabet. Here you can have a debate and whether AI is a threat to Google, and there are some good arguments for that, but you can also sort of take the other side of the case. Either way, one thing that we think is often overlooked is the fact that Google has an enormous R&D budget. I mean, last year they spent $45 billion on R&D. So if this money is sort of again spent in a prudent way, it is a hard competitor to duke it out with. So Google has, we think, every chance in the world to become a winner in the AI space, even though again it's probably not priced in the stock at current levels. So it's a nice option more than anything right now.